questions of our witnesses. The staff have been instructed not to mute members except where a member is not being recognized and there is inadvertent background noise. Members are also reminded that they may only participate in one remote proceeding at a time. If you are participating today, please keep your camera on, and if you choose to attend a different remote proceeding, please turn your camera off. If members wish to be recognized during the hearing, please identify yourself by name to facilitate recognition. I would also ask that members be patient as the chair proceeds, given the nature of conducting committee business virtually. This hearing is entitled Monetary Policy and the State of the Economy. I now recognize myself for 4 minutes to give an opening statement. Welcome back, Chair Powell. Since your last testimony before this committee, the COVID-19 pandemic has continued to have a devastating impact all across the country. Over 500,000 people in the United States have lost their lives to the virus, and there have been 27.9 million US cases of the virus. The economy continues to be in a crisis. Millions of families are struggling to make rent or mortgage payments through no fault of their own. Roughly 1/3 of small businesses remain closed, and many more are at risk of permanently shutting their doors. I'm so glad that we now have President Biden providing leadership from the White House and a real plan to tackle this crisis once and for all. With Democrats now in control of the Senate, Congress can carry out that plan and provide the nation with the relief it so urgently needs. This committee has advanced legislation in our jurisdiction to implement President Biden's American Rescue Plan, and the full House will take up this legislation later this week. After gross, if not criminal, mismanagement of the crisis by the Trump administration, Americans have shown that they want competent leadership and decisive action to crush this virus and put the economy on the road to recovery. But even after Congress passes the American Rescue Plan, the country still needs the Federal Reserve to adapt and to stand ready to use all of its tools at its disposal to ensure an equitable and swift recovery. It is long overdue for the Fed to reconsider its normal operating procedures and use its authorities to tackle the racial wedge and employment gaps. The Fed must act vigilantly against ongoing signs of systemic stress, putting a stop to the deregulation that preceded this crisis. The Fed must continue to be attentive to inequality as it oversees this recovery, taking the impact on consumers and small businesses into account when considering mergers in the financial industry. And the Fed must proceed with greater alacrity regarding climate risk in its supervision of financial institutions. The Fed has recently taken a few steps in this regard, but much more is needed to combat the systemic and existential threat. I look forward to your testimony and to discussing these matters today. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Chairman Powell, I'd like to commend you again for your swift response to the pandemic. The Federal Reserve was the fastest acting part of the federal response, thanks to your foresight and leadership. As we've discussed previously, Chair Powell, there is a clear distinction between what is fiscal policy and within the purview of Congress, and what is monetary policy and within the purview of the Fed. I appreciate your work to protect the independence of the Fed, and I know that you'll continue to do so. We have politicians that are talking down our economy, even the Speaker of the House saying, quote, the economic crisis is accelerating, end quote. And they're saying this specifically to pass their spending package. Our economy is on the mend, despite what politicians parrot as their preferred narrative. The first phase of the storm is passing. Now we have to deal with the damage COVID wrought, and it did indeed bring significant damage. And the virus, the shutdowns, schools not reopening, the lack of childcare, all have had serious consequences. These are maladies which the Fed cannot fix. In fact, Congress doesn't seem to have the power to do it either. It's governors in the states they lead who are showing the path forward. Money alone will not fix it. Vaccines, testing, treatment, and data-driven public health decisions will have a larger impact than either monetary policy or fiscal policy at this stage of the game. What's called for is targeted temporary relief directly related to COVID, not a typical Keynesian stimulus bill in the name of COVID relief. To be clear, we know there are many Americans still suffering. Behind every statistic is a family that is still reeling from this crisis. For a year now, we've been working to reach those in need. As you've said, Chairman Powell, this is a tale of two recoveries. Employment for the top quartile of wage earners has fallen by 4%, while the bottom quartile has dropped by a full 17%. So let's dig deeper here. More than 4 million Americans have been unemployed for almost a year. In the restaurant industry alone, 1 out of 6 businesses have been shuttered since last March. And while the CBO projects the unemployment rate, which currently stands at 6.2%, which by the way is lower than the unemployment rate under the first 5.5 years of President Obama, that unemployment rate will continue to fall this year and to reach a pre-pandemic size of 2022 under the current, without any other additional fiscal action. There are millions of Americans, families juggling work, childcare, and paying and just praying that their schools will finally reopen. Yes, personal incomes have actually increased at the end of last year, and the personal savings rate stands at over 13%, a level not seen in 4 decades. Yet childcare costs have jumped by almost 50% since last year. A year ago, women outnumbered men in the workforce. And since the pandemic, 2.5 million women have left the workforce. Given the nature of the shutdowns, this temporary aid that we provided last year, and the Fed's swift actions, they prevented the worst from possible outcomes from occurring in this crisis. Now we have to deal with the divide, the uneven recovery that has occurred. And as we exit this pandemic, we need to find innovative solutions that support finding employment for these Americans and bring those who exit the labor force completely. We need to bring them back in. And the Fed must also focus on regulatory flexibility and provide flexibility to financial markets to ensure that we have a less choppy recovery. And indeed, Chairman Powell, there are new challenges and choppy waters ahead. And I'm grateful for your steady hand and pragmatic leadership at the Federal Reserve and for our economy and for our government. Thanks so much, and I yield back.
Thank you. I now recognize the chairman of the subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Connecticut, Mr. Himes, for 1 minute.
Thank you, Madam Chair. And Chairman Powell, thank you for being here today. And let me echo our thanks for your incredible intervention and work in addressing the economic aspects of this pandemic. In 2008, the Federal Reserve took extraordinary actions, including the then controversial use of its emergency lending powers to rescue the financial sector. And the pandemic has shown us that the need for the Fed to engage in emergency intervention remains. When you were last testified before this committee in December, we discussed the wisdom or lack thereof of shutting down those emergency facilities before the pandemic was over. And then at the end of last year, we saw troubling signs on the horizon of elevated unemployment numbers and an uptick in business bankruptcy. So clearly we're not out of the woods. And if 2008 and 2020 have taught us anything, it is that crises happen and we need to prepare for them. Now, unlike in 2009, fiscal policy will be heavily deployed and our shoulder will be to the wheel. Nonetheless, the Federal Reserve is arguably the major player in our capital market. So I look forward to hearing from you today, Chairman, not just on where we are, but how this ends. How does it unwind? A look at page 43 of your monetary report shows the incredible interventions. And the question is, how does this unwind and where do we go from here? With that, I yield back.
Thank you. I now recognize the ranking member of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Arkansas, Mr. Hill, for 1 minute.
Thank you, Madam Chair, and I want to echo the comments from my friend and Chairman Himes of the subcommittee. We thank you, Chairman Powell, for the extraordinary actions of the Board of Governors during 2020 in monetary policy and in the extraordinary facilities and using 13.3. And we also commend the Congress and the executive branch in 2020 for their fiscal response, which gave us the resources we needed to fight the pandemic and get our economy to the point it is today to open. So I agree with Chairman Hines that now it's time to look on the other side of this pandemic. As we vaccinate America, as we get our businesses open, as we see state and local governments having far in excess of the tax revenues that they anticipated and people getting back to work, how do we safely open this economy, get those jobs available for those 10 million Americans still seeking employment? And I look forward to your testimony today. I yield back, Madam Chair.
Thank you. I want to welcome to the committee our distinguished witness, Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell has served on the Board of Governors since 2012 and as its chair since 2017. Chair Powell has testified before this committee, and I believe he does not need any further introduction. So without objection, your written statement will be made a part of the record. I want to remind members that Chair Powell has a hard stop and will be with us for 3 hours until 1 p.m. Eastern Time. Chair Powell, you are now recognized to present your oral testimony.
Thank you and good morning to all. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide support and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to households, businesses, and communities. Today, I will review the current economic situation before turning to monetary policy. The path of the economy continues to depend significantly on the course of the virus and the measures taken to control its spread. The resurgence in COVID-19 cases, hospitalizations, and deaths in recent months is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, momentum slowed substantially, with the weakness concentrated in the sectors most adversely affected by the resurgence of the virus. In recent weeks, the number of new cases and hospitalizations has been falling, and ongoing vaccinations offer hope for a return to more normal conditions later this year. However, the economic recovery remains uneven and far from complete, and the path ahead is highly uncertain. Household spending on services remains low, especially in sectors that typically require people to gather closely, including leisure and hospitality. In contrast, household spending on goods picked up encouragingly in January after moderating late last year. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to unprecedented fiscal and monetary policy actions, which have provided essential support to many households, businesses, and communities. As with overall economic activity, the pace of improvement in the labor market has slowed. Over the 3 months ending in January, employment rose at an average monthly rate of only 29,000. Continued progress in many industries has been tempered by significant losses in industries such as leisure and hospitality, where the resurgence in the virus and increased social distancing have weighed further on activity. The unemployment rate remained elevated at 6.3% in January, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. As discussed in the February Monetary Policy Report, the economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers and for African Americans, Hispanics, and other minority groups. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices partially rebounded over the rest of last year. However, for some of the sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer run objective. While we should not underestimate the challenges we currently face, developments point to an improved outlook for later this year. In particular, ongoing progress in vaccinations should help speed the return to normal activities. In the meantime, we should continue to follow the advice of health experts to observe social distancing measures and wear masks. I'll turn now to monetary policy. In the second half of last year, the Federal Open Market Committee completed our first ever public review of our monetary policy strategy, tools, and communication practices. We undertook this review because the U.S. economy has changed in ways that matter for monetary policy. The review's purpose was to identify improvements to our policy framework that could enhance our ability to achieve our maximum employment and price stability objectives. The review involved extensive outreach to a broad range of people and groups through a series of Fed Listens events. As described in the Monetary Policy Report, in August, the committee unanimously adopted its revised Statement on Longer Run Goals and Monetary Policy Strategy. Our revised statement shares many features with its predecessor. For example, we have not changed our 2% longer run inflation goal. However, we did make some key changes. Regarding our employment goal, we emphasize that maximum employment is a broad and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for low and moderate income communities. In addition, we state that our policy decisions will be informed by our assessments of shortfalls of employment from its maximum level, rather than by deviations from its maximum level. This change means that we will not tighten monetary policy solely in response to a strong labor market. Regarding our price stability goal, we state that we will seek to achieve inflation that averages 2% over time. This means that following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. With this change, we aim to keep longer run inflation expectations well anchored at our 2% goal. Well anchored inflation expectations enhance our ability to meet both our employment and inflation goals, particularly in the current low interest rate environment in which our main policy tool is likely to be more frequently constrained by the lower bound. We have implemented our new framework by forcefully deploying our policy tools. As noted in our January policy statement, we expect that it will be appropriate to maintain the current accommodative target range of the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at their current pace, until substantial further progress has been made toward our goals. These purchases and the associated increase in the Federal Reserve's balance sheet have materially eased financial conditions and are providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it's likely to take some time for substantial further progress to be achieved. We will continue to clearly communicate our assessment of progress toward our goals well in advance of any change in the pace of purchases. Since the onset of the pandemic, the Federal Reserve has been taking actions to support more directly the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. Finally, we understand that our actions affect households, businesses, and communities across the country. Everything we do is in service to our public mission. We're committed to using our full range of tools to support the economy and to help ensure that the recovery from this difficult period will be as robust as possible. Thank you. I will look forward to your questions.
Thank you, Chairman Powell. I now recognize myself for 5 minutes for questions. During our committee markup on February 10th, some members of our committee tried to suggest that further fiscal action was not needed because we are on a swift path to recovery. For example, it was noted that the unemployment rate in the United States is currently better than it had been for the first 5 years of the Obama administration. On that same day, you gave a speech that warned against this sort of top-line assessment of employment, noting that, quote, employment in January of this year was nearly 10 million below its February 2020 level, a greater shortfall than the worst of the Great Recession's aftermath, quote unquote. Chair Powell, do you believe our economy is in a healthier position right now than it was in 2014, several years into the recovery from the Great Recession?
I'm reluctant to make that comparison without thinking about it further. I will just, though, echo that we have 10 million fewer people working on payroll jobs than we had just 1 year ago today, and that the unemployment rate, the reported rate, is 6.3%. But if you include people who were in the labor force and indeed working in February and a couple of other adjustments, you get to almost a 10% unemployment rate. So there's a lot of slack in the labor market and a long way to go to maximum employment.
Thank you. In that same February 10th speech, you mentioned that, and let me quote, fully recognizing the benefits of a strong labor market will take continued support from both near-term policy and longer-run investments, quote unquote. Certainly, it will take a longer-run investments to achieve a true full employment economy that lifts workers' wages and finally closes the racial wealth gap. As Congress considers President Biden's American Rescue Plan, some of my colleagues have said we should, quote, wait and see, quote unquote, before spending more. Chair Powell, does the economy need additional fiscal support from Congress right now? Also, how critical is it for Congress to make longer run investments if we want to eliminate the racial wealth gap?
What I was really saying, Madam Chair, with that was that we've shown that we can, over the course of a long expansion, we can get to low levels of unemployment, and that the benefits to society, including particularly to lower moderate income people, are very substantial. We've shown that we can do that, but it's not really a great strategy to wait until the 8th or 9th year of an expansion to get those benefits. To really improve through the cycle, what I was saying in that set of remarks was that it'll take the private sector and it'll take investments from the public sector in, frankly, in the workforce, education, training, policies that support workforce participation, things like that. That's what I was really getting at there.
Response. And with that, I'm going to yield back my time, and I'm going to call on the gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee. You are now recognized for 5 minutes.
Well, thank you, Madam Chair. In fact, I think your workforce speech your labor market speech was a very important one for all of us to take note of. And this recovery is different than the recovery from the financial crisis. It took much longer for us to get to this rate of unemployment than it did post-financial crisis. And as I mentioned in my statement, that the chairman of the committee was kind enough to quote from, is that the labor market now is better than it was in President Obama's first term of office. So these recoveries are different. Now, also, you had a broad-based recovery that took almost a decade to come about with post-financial crisis. But right now, you have segments of the economy, like you mentioned in your statement, Chair Powell, about hospitality, that is lagging because of state shutdowns. But in your testimony, you mentioned the Fed's exit strategy is contingent on meeting the Fed's goals for economic recovery. So how close is the economy to meeting the Fed's goals, and what does that look like?
So what we've said is that we would be purchasing assets at least at the current pace until we see substantial further progress toward our goals. So that's actual progress. That's not forecast progress. So we would want to see that we moved it is what it sounds like. We would like to see incoming actual data that show us moving closer to our goals, both for inflation and for employment. And that's what it'll take. And I agree there's an element of judgment in that, but we will be communicating as clearly as possible and as far in advance as possible how we perceive the path of progress toward those goals.
Okay, consistent with your mandate, consistent with the mandate.
Very much so.
So what does the labor market look like when the Fed has achieved this goal? What does the labor market look like?
So I think it's easier to say with liftoff. We've been very specific with liftoff. We said in liftoff we'd need to see labor market conditions that are consistent with maximum employment, inflation at 2%, and inflation expected to move moderately above 2% for some time. Those are the conditions for liftoff, and they're quite specific. We haven't tried to be that specific about the pace of asset purchases, and we've just said substantial further progress is what we said.
Okay. So Chair Powell, yesterday you also spoke about the digital dollar being a high priority for the Fed. I think this is a national security issue, an economic security issue for sure. You said you're committed to transparency as you look into the digital dollar. I think that's important. I think that's very important for our system of government. I think it's a very important thing for an open society. But let's get into a few specifics on that if we can. What can the public expect in terms of learning the details of this project going forward? And are some more details, are you able to share with us today what we can expect from the Fed in this year, over the course of this year with the digital dollar project?
Yeah, so this is going to be an important year, and this is going to be the year in which we engage with the public pretty actively, including some public events that we're working on, which I'm not going to announce today, but there are things that we're working on. And it's the sense of this is not, here are the decisions we've made, what do you guys think? It's going to be, these are the trade-offs, they're both policy questions and there are technical questions that interrelate between those two, and they're very challenging questions. And so we're going to want to have a public dialogue about that with all of the interested constituencies. And that is the idea of what we're doing. In the meantime, we're working on the technical challenges and also collaborating with and sharing work with the other central banks around the world who are doing this. And, we will need, depending on what we do, we could well need legislative authorization for such a thing. That isn't clear until we see which way we're going. But so we will be engaging significantly with you and your colleagues on Capitol Hill as well.
Okay. So I think the project's vital. I think it's vital for American competitiveness. But I also, there's a fear that some want to use the digital dollar as a way to kill private sector innovation and in our banking system. Implementing modern monetary policy, modern monetary theory, for example, vis-a-vis Fed accounts. What do you say to folks hoping to exploit the digital dollar project in that way?
Well, one thing we need to be very mindful about is that we have a functioning financial system and a banking system and capital markets which intermediate between savers and borrowers, and they're the best markets and I would say the strongest banks in the world. We need to be careful with our design of the digital dollar that we don't create something that will undermine that very healthy market-based function. That's one thing, for sure.
Now, final question here. You mentioned the labor market. We talked about the labor markets. As far as the fiscal side of the house, what are the things that we should be doing? What are the biggest challenges to getting people back to work?
Well, the single biggest, as you well know, unemployment and low activity is concentrated in that reasonably broad sector of the economy, in the service sector, where people gather closely together. Travel and entertainment, leisure, that whole hotels, those sorts of things. The single most important policy to getting those sectors reopened and getting people back to work, of course, is bringing the pandemic to a decisive end as soon as possible. And we're on the path to that, but we haven't done it yet. So I think it's important that we do quite decisively this year.
Thank you. Thank you, Chair Powell. Thanks for your leadership.
Ms. Velasquez, who is also the chair of the Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman. Chairman Powell, I heard you speak about the changes in the FOMC's monetary policy framework in your opening statement. It is clear that the pandemic has had an outside impact on women, minorities, and younger workers. How will the changes in the FOMC's monetary policy framework benefit workers in these groups?
So what we learned in the course of the last expansion was that we could have an unemployment at historically low levels without seeing troubling inflation arise. So we took that on board in creating our new framework. And as I mentioned in my remarks, that means that we won't tighten monetary policy just because of a strong labor market. We want to see either inflation moving up in a troubling way or other risks to the achievement of our goals. And that puts us in a place where we can have low levels of unemployment again. And when we get to those low levels, we see that they do benefit low and moderate income communities and women and minorities more than others who tend to benefit earlier in the expansion. So that plus what we said about maximum employment being a broad and inclusive goal, I think what I would point to.
Very good, thank you. Chairman Powell, in May 2020, the OCC finalized a rule substantially revising the Community Reinvestment Act, which the Fed and the FDIC did not sign onto. In September 2020, the Fed proposed its own update to the CRA. With the change in the administration, do you expect the Fed to re-engage with the OCC and the FDIC on CRA rulemaking? And do you think there is an opportunity for a harmonized rule amongst all three agencies?
I think there is an opportunity for a harmonized rule among the three agencies. And we are engaged, have been engaged, and continue to be engaged with the FDIC and the OCC, and we're working on that very thing.
Do you have a timeline?
I think we're just getting started.
Okay.
There will be a new comptroller, but nonetheless, we're working on it. And by the way, it will be one that has broad support among the community of intended beneficiaries, which was always the Fed's test and my test for what it would take for the Fed to support reform of CRA.
Glad to hear that, especially at this time when underserved communities, minority and female businesses and all that have been impacted by this pandemic. And CRA is a way to lift up communities of color, particularly. Chairman Powell, last week, Governor Brainerd gave a speech on the role of financial institutions in tackling the climate challenge. In her speech, she stated, and I quote, "Climate change is already imposing substantial economic costs on the economy and is projected to have a profound effect on the economy at home and abroad." Would you agree with her statement, and can you give some examples of how you see that to be true?
Well, I think climate change is a very important issue. And if you'll allow me, I will start by saying that the nation's policy on climate change really needs to be set in the first instance by you, elected representatives in the House and Senate, and then by the administration through the agencies that Congress has created. Our role is really that of assuring that we are using our powers to carry out our mandate in supervising financial institutions to make sure that they're resilient to all risks, including that of climate change. That's what we are.
And can you explain the steps the Fed will be taking over the next 18 to 24 months to ensure the financial system can deal with the future financial and economic risks posed by climate change?
Yes, so we're doing right now a great deal of outreach and research and consultation. And by the way, the larger and medium-sized banks are doing the same thing. It is really time to have this, to do this work and to try to understand. Climate change is a longer run issue to deal with, and you will see that the financial institutions themselves are very focused on understanding how it will over time affect their business model. We're looking at the same thing from the standpoint of a regulator and supervisor. So research and basic work to lay out a framework, which will take some time, but it is time for us to do that.
Thank you. I yield back.
Thank you. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
Thank you, Madam Chairwoman and Chairman Powell. It's good to see you again. Thank you for being here today. Thank you for all that you and the Fed have done during this unprecedented pandemic. Under the Fed's average inflation targeting, you are looking for inflation to be, and I quote, moderately above 2% for some time to make up for undershooting inflation in the past. What does moderately above 2% for some time mean specifically? And why do we believe this is achievable if the FOMC's 3-year projections for quite some time now have been forecasting inflation, in fact, of 2% or less?
So on the first part, what does moderately mean? We don't have a formula, and we're not going to have a formula. The sense of it, though, is that we want inflation to average 2% over time. And the reason we want that is that we want inflation expectations to be anchored right at 2% and not somewhat below 2%, which is arguably the case now. That's really how we're looking at it. In terms of can we get there, I'm confident that we can and that we will, and we are committed to using our tools to achieving that. The 3-year time frame is actually an arbitrary 3-year time frame chosen by us. And we're just being honest about the challenge. We live in a time where there's significant disinflationary pressures around the world, and where essentially all major advanced economy central banks have struggled to get to 2%. We believe we can do it. Believe we will do it. It may take more than 3 years, but we'll update that every quarter. We update that assessment, and we'll see how that goes.
Thank you, Chairman Powell. I know you were asked a number of times by my colleagues in the Senate yesterday whether the Fed intends to extend the exclusion of low-risk assets such as treasuries and reserve balances from the supplementary leverage ratio. I strongly supported the agency's decision nearly a year ago to make this exclusion in recognition, I think, of the fact that banks were receiving just an unprecedented amount of new deposits, largely as a result of the Fed's actions that continue to put pressure on leverage ratios. You indicated, sir, yesterday that the Fed is still considering whether or not to provide an extension. Do you agree that the exclusion proved to be an important tool to preserve liquidity in the Treasury market?
Yes, I do agree to that. But I mean, we're just looking at this. I don't really have anything for you on that decision. But I didn't have anything yesterday, as you pointed out. So we're looking at that, and we know when the deadline is, and we're working on that, and we'll come forth with something relatively soon.
Well, I hope it's relatively soon, Mr. Chairman, because given that we're still considering new stimulus and other accommodations to continue economic recovery, I'm concerned, and I'm wondering if you are concerned about that arbitrarily removing the exclusion on March 31
with Fundrise
could put additional pressure on the Treasury market. I mean, making sure that the SLR is extended, I think, is very, very important as we continue this recovery. And as I said, as further stimulus actions are considered and put into law. March 31 is nearly upon us, Mr. Chairman.
Yes, it is.
Oh, come on. Surely you can talk to us a little bit more about how important that was over the past year in terms of our banking industry and to keep liquidity in the market, given the large number of deposits that were extended to our banking community?
I'm just going to say that we're having discussions on it right now and internally here, and I really don't want to go any further than that. I'm sorry, but we're making a decision, we're considering it, and when we have a decision, we'll come forward. I'm sorry.
I respect that, and I look forward to that decision. And Madam Chairman, I yield back. Thank you.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
Thank you. Mr. Chairman, it's good to hear about your Fed Listens events, but I assure you your best Fed Listens event is right here today. You will not find 50 people in better touch and more representative of the 320 million Americans. I've grown old serving on this committee, and I've seen your predecessor come here, and Republicans attack them for what they regarded as a too expansionary monetary policy, whether the expansionary system be the traditional or the relatively newfangled quantitative easing. It's good for me to live long enough to see that many of the Republicans are moving in our direction toward the need for a somewhat more expansionary monetary policy. And I would hope that you would be looking at 2.25% rather than 2% as your target. I also commend you for the quantitative easing. It has allowed you to remit to the federal government $50 to $100 billion in each of the last several years. And so those who criticize your big balance sheet have been unwilling to identify which taxes they would raise in order to make up for that lost revenue. Also, your quantitative easing, big balance sheet approach is the only tool you have to influence long-term interest rates, which I think are much more important to our economy, since you have to borrow long-term to build a factory or build a business. And I prefer monetary policy to an expansionary fiscal policy, because all of your tools reduce the federal deficit, and all of our tools increase the long-term federal debt. I want to focus your attention on LIBOR. It now appears as if the LIBOR index will continue to be published till June of 2023. It's almost disappointing to get a reprieve, and that it will reduce the pressure on us to actually solve this problem. But it does give us more time. And there is, of course, the Alternative Reference Rates Committee, ARC, and we have legislation to facilitate how to deal with what will be $2 trillion of existing contracts that don't have backup language. I wonder if you can confirm for me, in your view, is it necessary to have federal legislation to have a smooth transition after June 2023, when LIBOR is no longer published?
Yes, we think it will be. As you know, many LIBOR contracts are going to run off before then, but there'll be a hard tail, as we say, and we do think federal legislation is the best answer.
And there are those who think that the private sector can just invent a synthetic LIBOR and that would solve the problem. Is that as good a solution as federal legislation?
No, federal legislation creating a path for a backup would be the best solution, we think.
Thank you. Now I want to move to something that we've talked about before, and that some will regard as a small issue, and that is the system for avoiding wire fraud. When we've talked about this earlier this month, where usually it's somebody trying to buy a home the first time ever, when they'll remit $10, $20, $30, $50,000 for the down payment. It's their life savings. And they're tricked into wiring the money to the wrong account number, and they lose it forever. Now you're developing the new FedNow system, and your bureaucrats have told us that they don't want to engineer that system to avoid this tragedy that occurred, as I said, affecting $150 million just last year. That they don't want to do the really simple thing of just saying that when you remit money, you identify not only the account number you're sending it to, but the name of the person you're sending it to. And I know your bureaucrats will tell you they don't want to do it. I wonder whether you'll go back to your agency and get personally involved and push them to avoid this tragedy. I don't think your successor should have to, face people at the next Fed Listen session, maybe 10 years from now, who have lost their homes as a result of this. Can you commit to getting personally involved and having a system that will hopefully protect homeowners or home buyers?
So I think, as you know, we've looked carefully at this and concluded that payee matching is not the best way to do it. And there are just problems in the US system, but we have other ways to do it well. I'll be happy to go back and revisit that though.
If there's another way, let me know what it is, because your staff just tells me they don't want to do it. I
The
yield back.
gentleman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, you know I have a tendency to focus on those things that affect my people back home up and down Main Street and across the 3rd District of Oklahoma. So let's discuss for a moment. When you were last before the committee in June, you noted that the U.S. banking system has been a source of strength during the pandemic. The Fed's monetary policy report released on February 19 reaffirmed this point, stating that institutions at the core of the financial services system remain resilient. Do you continue to believe that banks are a source of strength? And will you elaborate both on what that means for the economy and for banks' abilities to lend, yes, absorb losses potentially too, and provide liquidity in distressed markets?
Yeah, so we've, like, you know, we spent, and the bank spent 10 years in a strengthening process, higher capital, better risk management, higher liquidity, all of those things. And then we received a world historical sized shock in the form of the pandemic. And I think, essentially close to a year into it, almost exactly a year into it, we see so far, what we see is that our banks have held up quite well. And their capital, the big banks' capital has actually increased over the course of the last year, while they've also taken 100 billion plus worth of reserves against losses. And so they are able to keep lending. They're not a source of weakness. At the beginning of the pandemic, they were very important because they did absorb that huge flow of deposits, and they made all of those loans as companies pulled down their lines of credit. Now, those were paid back early on, but at the very beginning, when it mattered a lot, they were a source of strength. So I think all of that is right. We've always got to continue to be vigilant on those things, but a first draft of history is that the banks are strong. And I would say the same for small and medium-sized banks as well, have generally held up well. There are going to be issues, and as we come out of this, there are going to be businesses that fail and there will be losses, but it's quite different, a very, very different situation than we had after the global financial crisis.
Absolutely. And Mr. Chairman, let's discuss for a moment a topic that's very important not only to me, but my friends in the majority on the Financial Services Committee. The national unbanked rate has been falling steadily for the past decade, and since the last calculated in 2019 sets at about 5.4%. Still, this represents more than 7 million U.S. households without a checking or savings account. Unfortunately, the COVID-19 pandemic is likely to contribute to an increase in the rate of unbanked households. Chairman, what would you suggest to reduce the adverse impact on the unbanked and underbanked in the aftermath of the pandemic to ensure that no one is left out of the economic recovery?
I think it's a serious problem to address. We tend to address it through our community affairs and efforts to make sure that, fair lending policies and things like that. I also think that there's more that Congress can do, I'm sure, to assure that people have, education around financial matters. And the other piece of it is, there are people at the lower end of the income spectrum who are living hand to mouth. We need a strong recovery. We need continued support for monetary policy, and we'll be providing that as well.
One last question, Chairman, and it impacts the ability of every Main Street to function. According to FDA, the United States administered more than 63 million doses of COVID vaccine, COVID-19 vaccine. Chairman Powell, can you expand on how important to the economic recovery or how dependent the recovery is on ramping up that manufacturing and distribution?
Yes, this is the weakness we see in our economy now is unusually concentrated in a set of industries that involve people getting really close together. Hotels, restaurants, travel, entertainment, all those places. And that's millions of people who aren't working and businesses that may have been in business for generations going out of businesses. That's what that is. And the way to get after that is through by successfully, decisively bringing the pandemic to an end as soon as possible. That's the single best growth and economic and prosperity creating measure that any of us can undertake. And that is the vaccination. It's continuing to observe social distancing and wearing masks. Hopefully we're on that road now. And if we are, we're going to see, there's grounds for optimism in the second half of the year for the economy.
The gentleman's time has expired. The gentleman from Texas, Mr. Green, who is also the chair of the subcommittee on oversight and investigations, is now recognized for 5 minutes.
Thank you very much, Madam Chair, and I thank the witness for appearing. I'm always honored to have him here before the committee. My question has to do with the State Small Business Credit Initiative. This is an initiative that was started under a Republican administration. It has served us exceedingly well, and the chairwoman, with her insight and foresight, has expanded this program to make sure that it covers women and people of color to a greater extent. We're talking about having this initiative be funded with $10 billion, and this is in the COVID package. And this $10 billion can drive up to $100 billion of private sector investments in these small businesses. States would be required to submit a plan, as well as other jurisdictions, on how expeditiously these funds can be delivered to help small businesses respond to and recover from the pandemic. A plan to encourage participation of MDIs, minority depository institutions, as well as CDFIs, community development financial institutions, would also be a part of this. Mr. Chairman, my question to you is simply this: how important is it that small businesses receive these capital investments? They sometimes find it exceedingly difficult to acquire funds of this type, the type that we have in this package. How important is it that these funds during this pandemic get to these small businesses?
Well, small businesses are under a lot of pressure in this at the current time, more so than many of the larger businesses that had resources to get through this. I would say MDIs and CDFIs are very important channels for reaching them. It's not appropriate for me to take a position on this particular provision and its inclusion in the in legislation, but I would just say that it is important for small businesses, and you mentioned MDIs and CDFIs. We, as you know, we work very closely with those organizations and think highly of the contribution they make to our economy.
Yes, sir, and I concur with what you said about working closely with them. I happen to be aware of some of your good works. The community banks, as you know, I'm very much concerned about them, and some of them are on the margins, and this type of assistance to some of these smaller banks can be of great help to them. I don't want you to comment on a specific bank or specific banks in general, but I am concerned about the need to maintain these institutions that have a niche. They have a clientele that somehow and sometimes will not be met. Their needs won't be met if they don't have these institutions that are in the communities. Have you found that it's good to have these institutions in these communities where the need is not always met?
Yes, I mean, we think community banks are a very important part of the fabric of our society, and we see them under longer term secular pressures, they've been declining, and we don't want to do anything that adds to that through regulatory burden. And actually, we've got a subcommittee. We have a community banker on the board of governors, and we try to do everything we can to not be part of the problem, because people are leaving small towns and moving to cities and things like that, and that is putting pressure on rural community banks. But overall, they know their communities, and we want them to operate safely and soundly and successfully in their communities.
Well, thank you very much. I have very little time left, so what I would like to do is simply acknowledge the chairwoman for helping us to get this $10 billion into the COVID package. Ms. Beatty also helped us to modify it along with one of my Republican colleagues, so that the very small businesses will get some help. There are small businesses, and then there are very small businesses, and we don't want to leave any of them behind. So, Madam Chair, I thank you very much for the opportunity to ask these questions. I yield back.
Thank you very much, and I appreciate your comments. I will now recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Well, thank you very much, Madam Chairwoman. I'm pleased that we have this opportunity to hear Chairman Powell's semi-annual report on the state of monetary policy. We've all shared quite a year since February 2020 hearing, when the virus was just breaking over the horizon. And we continue to be motivated and preoccupied with the horrendous, unprecedented event. Through no fault of their own, our constituent families and their small businesses experienced perhaps the worst economic downturn in our history, and theirs. It was absolutely right to address the suffering of our workers and their families, and we can be proud of the bipartisan response in the public laws we passed, such as the CARES Act. We are now in a period of somewhat less consensus about the next thing to do. On the one hand, the administration and others are saying that we need to go big on spending, and this week the House is slated to vote on their $1.9 trillion big plan. Notably, the big plan spends money with a wide scope, and of course the money will likely all need to be borrowed. Others are saying that in many sectors the economy is doing well, but that in other sectors like hotels, restaurants, and tourism, workers and businesses are still suffering. Now, thus, many people say that the targeted relief will be a better approach and save us borrowing to the tune of $1.9 trillion. And I associate myself with the targeted approach, by the way. Mr. Chairman, I'm wondering, you've been urging that monetary policy can't fully restore the economy, and you've made that clear today, and that fiscal policy must play an essential role. Just after the Federal Markets Open Committee meeting on January 29th of 2020, you said, quote, "The labor market continues to perform well. The labor market continues to be strong. We see strong job creation. We see low unemployment. Very importantly, we see labor force participation continuing to move up." End of quote. Fiscal policy includes taxes as well as spending. Things look really good in January of 2020. In fact, far better than, say, 4 years earlier. Given your knowledge of fiscal policy, did Fed research suggest that the reduction of personal taxes and corporate tax and reductions in regulation work to reduce unemployment to historic lows, generally and among many diverse groups? I'm not able to get the answer here.
The longest expansion in our recorded history actually began in 2009 and ended last year, as you point out, with the arrival of the pandemic. The labor market improved steadily and then gathered strength. Actually, the peak job creation year in that expansion was 2015. We did reach low levels of unemployment, and that includes particularly for minorities. And there was just a whole lot to like about where the labor market was last year. I'll just say that many, many factors contributed to that long expansion, and I don't know any way to unscramble the omelet on that.
Well, thank you. What does the apparent effectiveness of the fiscal policy of low income and corporate taxes and the policy of constrained regulation that started in 2017 teach us about the potential effects of increasing taxes and regulation as we try to recover from the pandemic?
It's not for me to comment on fiscal policy. We have a specific role and specific tools, and I'm going to stick to that.
So you don't have any opinion of what lower taxes and less regulations do to help an economy recover from the pandemic?
I think those are exactly the questions for elected officials. Those are right over home plate for you. You've given us a specific job, maximum employment and price stability. We use our tools, and we don't get involved in what are political judgments around fiscal policy. That's really for you and the administration.
All right, I just thought it was something that every person would have some opinion of, one way or the other. I see my time has expired, Madam Chairman. I yield back. Thank you.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes. We'll move on if he is not available. The gentleman from Colorado, Mr. President, who is also the chair on consumer protection and financial institutions, is now recognized for 5 minutes.
Okay, thank you, Madam Chair. Mr. Chairman, thanks for being here. Thanks for your service, especially during this last year. So I'm going to ask you sort of 4 different areas. First is going to be on that supplemental leverage ratio and see if I can get an answer out of you that Ms. Wagner didn't. Second will be on state and local governments and support for them. Third will be on bubbles that you may see existing. And the fourth will be on credit cards. So hopefully I can get to all of these. Last year in April, the Federal Reserve, the FDIC, eased capital requirements for financial institutions by allowing firms to exclude treasuries, U.S. treasuries, and deposits held at the Federal Reserve from the supplementary leverage ratio, the SLR. This was a welcome policy which helped stabilize the treasuries market and gave flexibility to financial institutions in a time of uncertainty. And I know with respect to your answers to Ms. Wagner as well as to the Senate, you all are sort of deciding what you want to do in that area, but I'm going to ask you a more general question. If regulators do not extend the SLR relief, do you think the additional capital requirements will have a meaningful effect on the bank's ability to lend into the recovery?
So I'm just going to say again, if I start answering these questions and get pulled down that slope, you know where I'm going to wind up. So I'm really, that's something that's under consideration right now, and I'm just going to have to leave it at that.
All right, so let's take the flip side, see if I can get you to answer this. I know that a number of institutions are interested in expanding their dividend program. Is the Federal Reserve considering allowing banks to offer more dividends?
So we don't have a decision on that. That's another thing that we will be looking at as well. What's been happening is we've been restricting banks from share repurchases and dividends, and as a result of that, they've actually built capital. And as time goes on, we'll be looking at that on a quarter by quarter basis, and that's coming up, but it's not today's decision.
Well, I know Ms. Wagner is going to feel good that you didn't answer either one of us, so I appreciate that, and I'm sure she does too. Let's turn to state and local governments, and on pages 24 and 25 of your report, and it's graphs 27 and 28, there appears to be a precipitous drop-off in revenues and taxes collected and employment at the state and local government levels. do you, in the legislation that we're considering, there is substantial assistance to state and local governments. Is this one of the areas of the economy that the Fed has been concerned about?
Well, we were quite concerned at the beginning because of the example of the global financial crisis, where weak revenues led to really weight on the recovery through some years. I'm not going to comment directly on whether you on the proposal that's under consideration right now, right in front of you this week. So what we see is that revenues have performed better than expected. They're about flat overall. Some states they're down a lot. Other states they're actually up. So we have a good picture of revenues. We have a picture of employment, and employment is down 1.3 million or so. A lot of that's education, which means people who work in schools, and that should be addressed by the reopening of the schools. The thing we don't have a great picture of, and you may be able to get it, is more the expenses. What are the one-time COVID-related expenses? So it's a complicated picture, and there's differences across the states. States have very different positions on this. So, and I know it's a question you're considering, and I'm sure your experts are focused on all of it.
Well, in Colorado, and looking at your report, I mean, obviously my state has a lot of leisure industry, tourism, and energy production. And it's hit us particularly hard in terms of employment and revenues. So last question. Do you see any bubbles that are of concern to you, whether it's stock valuations or real estate? Because on page 30, and I know my time is about to expire, you say that you see real estate prices are at all-time highs, but vacancy rates are at some all-time highs as well.
So your time is actually up according to my clock, but will I have time to answer this, Madam Chair?
Since I'm mute, go ahead and answer.
Okay, so I can't answer that in 10 seconds, right? So we have a broad framework for financial stability, one of the 4 pillars of which is asset prices. And there are some asset prices that are elevated by some measures, yes. Other aspects of the financial stability framework, leverage in the financial system is moderate. Funding risk is moderate. I would say leverage in the non-financial system has gone up a bit because of the pandemic.
All right,
very mixed picture.
All right, I thank you for your answers. I thank for the chair for extra time. I yield back.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Great to see you again, and thank you for your great leadership during the pandemic and this past year. It's been a trying time for all of us, and I think you've done a good job of steering the Fed through this storm, as the ranking member talked about it a while ago. One of the things that's concerning to me is I saw an article in a recent paper here with regards to the greening of the banking system, and I think my good friend Congressman Barr of Kentucky and I, he headlined a letter to the Fed, and I was one of other 45 members who signed on to it with regards to the Fed's including climate stuff into their stress tests. And while I understand the need for that to an extent, it certainly is concerning. It raises some flags for me from the standpoint that in an article here, it was talking, excuse me, a gentleman by the name of Ike Brannon, who's an economist and president of Capital Policy Analytics. He was talking about the stress test, and he said that it's a long-term goal of many who advocated that the Fed take this step, but he says, I think they have designs that go beyond climate change. Creating a system whereby the government can use its financial regulatory power to direct the economy away from businesses and industries it disapproves of is very much a goal of many Democrats in Congress and administration. Mr. Chairman, that sounds an awful lot like choke point to me. Operation Choke Point was something that we put the dagger in the heart of several years ago, and to resurrect that, to use climate change as an excuse to go after businesses who are doing legal business in a legal way, producing products and services we need as an economy is wrong. And I'm just wondering where you stand on that. Mr. Chairman.
Sorry. First, let me say that the climate stress scenarios are completely different from the stress tests. It's not the same thing at all. And but you really asked about a different question. Sorry, which was oh yeah. Just in 2 seconds, what was the question you did ask?
Well, basically, it's about whether you're weaponizing the regulatory system to do choke point stuff again, if on business, on banks that do not necessarily comply with what your climate agenda may be.
So we're not climate policy makers. Climate policy makers are democratically elected people, and those they delegate that authority to. So we're not thinking of it that way. We, as you know, as an institution, we've had a long held reluctance, resistance, and unwillingness really to engage in the allocation of credit. We think that is for the private sector, and if Congress wants to allocate credit in particular ways, that's fine. We don't want to get involved in that, and it's not something we're looking to do. What we're doing is well, go ahead. I'll let you go ahead.
Well, I would just make the point that we found during the Obama-Biden administration that Operation Choke Point was alive and well. It was instituted by them. It was carried out by them, and we tried to get rid of it during this past administration. So it's something that's there. It's something that we talked about a lot. But let me move on. With regards to the executive orders that are coming out of the administration right now, they're very concerning to me from the standpoint that by taking one of the executive orders off the books that President Trump put in place, that take 2 rules off the books for every one that he puts on, it's a signal to me that look out, here come the rules and regulations. And another one that they took off the books was one with regards to guidance, which is extremely important to me. FSOC, which you're a member of, came out and supported the overall rule of not enforcing guidance and had a policy-wide FSOC policy with regards to enforcement of that guidance. The administration came out with an executive order that said they're not going to enforce guidance across the entire administration. Now that issue is, that executive order has been rescinded as well. So my question to you is, I guess, do you see yourself relaxing some of the constraints that were in place as a result of the rule with regards to guidance? Is this something you're thinking about, or are you going to continue to comply with the rule that says you're not going to enforce guidance?
We don't enforce guidance, and that's not something we're changing.
Okay. It's concerning to me in that respect because it's something that I think we've worked hard to push out. And now we have a new regulator at CPB, which is looks like Richard Carter 2.0, but we'll wait and see once that comes out.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for this hearing. I look forward to this every year. Mr. Chairman, thank you for being with us today. And although I want to do the majority of my discussion with you about CRA, I've got to go to this New York Times article and ask what is your response to the article, which essentially is suggesting that particularly as it relates to economists, that African Americans are not even represented at the level they are in any other particular area. I think that the quote was in the article, Black people are less represented within the Fed than they are in the field as a whole. So can you give us your take on the article? Is it accurate? Is it fair? What do you think?
You know, I'm not the one to judge whether it's accurate or fair. It's not whether it's fair. I would say we're not where we want to be on this. We do work hard at it. It's something that I'm personally committed with, and that all the leadership of the Fed and the whole Fed is very focused on strengthening our workforce diversity. We are out there aggressively recruiting, both encouraging young minority kids to get interested in economics. I do that. I meet with people every year on that. Also, we go to historically Black and Hispanic colleges to encourage. And when we find candidates, we recruit them hard. And it's challenging. And I would just say that we're doing a lot, and I'd be happy to come up and share it with you in a lot of detail. But the results are not where we'd like them to be, and we're wide open to ideas, suggestions as well, and we'll just keep working on it. And believe me, we're working hard at it.
Yeah, and I appreciate your candor on that. And I know for the Kansas City Fed, for example, annually they were bringing up Black students from Kansas City to Washington, trying to give them this experience in hopes that some of them would eventually want to do this. So I don't think that there has been any intentionality on your part. I'm just trying to figure out what we can do with you to be helpful, and maybe we can talk about that at a later point. Because I'm very concerned about the CRA issue. It came about in 1977, I think, or somewhere about that time. The initial charge, of course, was that the lending institutions, banking institutions were not giving attention to certain areas of the city, and they were not investing, and in some cases, not even depositing in those areas. So we have CRA right now, but I'm having difficulty, and I intended to talk to the chair about this earlier. I didn't do it. I'm not sure that I can put my fingers on CRA projects or what they're doing in my local community. Maybe they're more visible elsewhere. But are you convinced that CRA is where it ought to be, or should we have some 21st century changes in CRA? Because maybe, as our chair has said, and I say everywhere I go, the one of the issues we have in that same area is the lack of affordable housing. And so, maybe it's time to look at a new way in which we can do CRA where it will be more effective and more visible.
Well, we place a very high priority on CRA. We think it's an incredibly important law, and we want it to be as effective as it can possibly be. And that's really what's behind the effort that we put into our proposal. We took a tremendous amount of input from from the groups who are intended to benefit from it, but also from the financial institutions who are also eager to make their communities better. So, so that's very much the spirit in which we approach this project. If you have particular ideas, we'd love to hear them. So,
well, regulatory agencies having a coordinated approach on CRA, and then maybe that's something that we have to talk about when we have time, because I think my time is running out. Madam Chair, thank you very much.
Thank you very much. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair and Mr. Chairman. Glad you are here. I want to do a quick, just sort of technical check. There was a Washington Post article, a number of other articles talking about your time yesterday at the Senate. You talked about the 6.3% January unemployment, but that is closer to 10. Are you talking about the U6 number that is typically published by Department of Labor?
no, I wasn't, although it's not dissimilar. What I was really saying that you know that if you haven't looked for a job in the last 4 weeks, then you're not considered unemployed. You're considered out of the labor force.
Yeah.
So a whole bunch of people, a couple million people, dropped out of the labor force who were actually working, and they're not counted as unemployed. But I'm saying for purposes of this exercise, we should think of them as unemployed because they want to come back in.
Which I talked about extensively during the recovery. You didn't need to look at the unemployment level. You needed to look at the U6 number that the Department of Labor publishes. So
same idea.
Okay. All right. I think has been explored, and you've acknowledged there is a completely uneven recovery happening in the economy. You and I have had a chance to talk about this in person as well. My district, which is an ag producer, I'm a home to Gerber Baby Foods. I've got a Heinz pickle plant. I've got Tyson Foods. I've got a number of specialty crops, blueberries, pickles, asparagus, et cetera. We're heavily agriculture, but we're also a heavy manufacturing district. But the third leg of our economic stool throughout Michigan, but especially concentrated in my district, is in that hospitality and tourism area. Housing fully recovered, as you had said. Manufacturing, at least in our area, especially automotive, office furniture, those types of things, mining, others, manufacturing, very, very strong. What we are seeing, though, is a desperation in that hospitality area. And I guess it begs the question of whether the economy is actually in crisis writ large, or do we have pockets of crisis within a reasonably healthy economy? I want to give you a quick second to answer that. And then I want to move on to the real estate question that my friend, Mr. Perlmutter, was talking about. I want to explore that a little bit more.
So the losses and the damage are concentrated in those industries that we talked about that you mentioned. It's also the case, though, that a number of other industries are short of where they would be if there hadn't been a pandemic. So there's broad amount of slack around, but it's really concentrated in those industries, which are, by the way, which are a big chunk of people. There are 10 million people, fewer people working, right? So it's a big number.
I will note a lot of that is in Michigan, we have 25% occupancy allowed for a restaurant, for example. Theaters are very sparsely populated. You can't do those types of things. So at some point or another, this isn't a federal issue. It is a local and state issue as to allowing those concentrations of people, as you know. Commercial real estate. Can you elaborate a little bit more what's happening in that commercial real estate space, especially? We're seeing very strong residential, but commercial space is what Mr. Perlmutter was going after.
Significant challenges for hotels, clearly, but also for office. And, the question is going to be how quickly can we get the pandemic over with and find out what equilibrium demand is going to be after that. People will still be staying at hotels, they'll be traveling, but office space, certainly in major cities, there may be more commuting. We don't know.
I think there's more hiccup within that business space, both business traveling as well as what work is going to look like. And I've got just a minute here, but one of the things I guess I'm getting at is there's a concern a lot of us have with this additional stimulus that's going to be getting put into the economy. Certainly the stimulus that the Fed has been providing. I want to know, is there a risk of overheating the economy writ large while by using these broad monetary tools and others to address underperformance in select areas such as hospitality and some of these more concentrated? In other words, are we creating a bubble in some of these other areas?
So our tools work in the aggregate, as you know, at the economy-wide level. And I would just say that we do expect inflation to move up, both because of base effects, as I discussed yesterday, and also because we could have a surge in spending as the economy reopens. We don't expect that to be a persistent, longer-term force. So while you could see prices move up, that's a different thing from persistent high inflation, which we do not expect. And if we do get it, then we have the tools to deal with it, and we'll use them.
Thank you. The gentleman's time has expired. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell. As you've noticed, we have a robust debate going on around here about a major fiscal package. I'm certainly influenced by what I saw 10 years ago when our fiscal response to another financial crisis was, in my opinion, deeply inadequate. I also believe that when thousands of Americans are dying every week still, it is far better to risk doing too much than to risk doing too little. Nonetheless, the concerns that are being raised about inflation, I think, are valid and need to be considered. I remember the early 80s, late 70s when inflation destroyed the savings of the middle class and reduced confidence in the economy. And it was very, very painful getting out of that. So my question for you, Mr. Chairman, is do you believe that there is some combination of expansionary fiscal and monetary policy that could lead to inflation? And I have two very specific questions. What to you are the leading indicators of that? And the other specific question is there some combination of challenged supply chains and surging demand that leads to an unhealthy level of inflationary pressure? And are you seeing any of those indicators at concerning levels at the moment?
So we know that inflation dynamics evolve over time, but they don't tend to change overnight. And so we've had, and I remember well, I was in college during the 1970s. I remember well high inflation and this feeling of powerlessness on the part of anyone to deal with it until finally Paul Volcker did exactly that. And we've been in a low inflation, disinflationary mode ever since. So what I see is an economy where there's still a great deal of slack. I see the prospect of really significant progress as we put the pandemic behind us. As we see that data, we've got in place guidance that tells markets clearly when we will begin to taper asset purchases and when we will begin to raise interest rates when the economy, in that case, when the expansion is very far advanced. So we have our tools, we have them in place, and we think that this is the appropriate policy stance. As I mentioned, inflation, it's something I remember well, and I'm very familiar with the history of the 1960s.
I guess, Mr. Chairman, sorry to interrupt. I guess my question is more about, I know where you are today, but I'm curious about what you consider the leading indicators, and in particular, whether you're concerned about challenged supply chains, because of course they are challenged.
So those are things like supply chains are, unless they're permanently challenged, there could be take an example of the chips issue with microchips issue right now. The automobile industry is having a hard time getting it. So this is a significant economic issue. And if there's a shortage of cars, then prices of cars might go up. That doesn't necessarily lead to inflation because inflation is a process that repeats itself year on year on year. So supply chain issues, as we get back up to full economic activity, you could hit supply chain constraints along the way, but that doesn't necessarily mean you will have a higher inflationary process if the Fed maintains its credibility and if inflation expectations remain anchored, which they weren't in the 1960s.
Thanks, Mr. Chairman. I have one more question, again, sort of rooted in the experience of 10 years ago. As somebody who was closely involved in the writing of Dodd-Frank, it's very gratifying to hear you say, I think you said that the banking sector has held up quite well. I remember 11 years ago, we were promised by some that Dodd-Frank was going to crush the American capital markets. We were promised by others that at the first sign of a stiff breeze, it would all come apart, and son of a gun, it held up pretty well. But I am always concerned about the risk that we don't see. So getting off of monetary policy, issuance volume in the high yield market, and I know these are a little bit outside of the banking sector, but SPACs, what, in my remaining 40 seconds, give me a sense of what is concerning to you that could challenge the stability of the financial sector?
Well, our policy is accommodative because unemployment is high and the labor market is far from maximum employment. We think that's appropriate. We do monitor all those things carefully. It's true that some asset prices are elevated by some measures. It's true that overall asset prices, I would say, are somewhat elevated. At the same time, we have a very resilient banking system, and we spend a lot of time making the capital markets more resilient as well. So overall, we're in a situation where accommodative monetary policy is working through financial conditions to support economic activity, and that's an appropriate thing.
Thank you.
Thank you.
Thank you, Madam Chair.
Time has expired. The gentleman from Ohio, Mr. Stivers, is now recognized for 5 minutes.
Thank you, Madam Chair. I appreciate it. Chairman Powell, thank you very much for being here today. I want to thank you for your steady hand of leadership during these very turbulent times. I also want to thank you for being the most accessible Federal Reserve Chair in the last decade during my time here through 3 Federal Reserve chairs, you've been absolutely the most accessible to us as policymakers, and I really appreciate that. I want to acknowledge your comments earlier about an appropriate direction forward for vaccinations to ensure we can open up the economy, and job training if we want to create jobs and get people to your maximum employment target. I'm not going to have you comment on whether the current COVID response bill focuses on that, because I know you don't want to be put in the middle of that. But I think it's fair to say anybody that researches it will see that the job training money rounds to zero, and there's not enough focus on vaccinations, in my opinion. I do want to move to something that I think you can and will be willing to talk about, and that's in the hospitality, travel, and entertainment industries. Do you believe banks and the capital markets are currently able to serve their capital needs with the regulatory flexibility you've given them?
Yes, yes, I do believe that.
Okay, thank you. And I think that one of the problems, though, let me ask you, is when they're so shuttered and their capacity is reduced, are banks and the capital markets as willing to give them money?
Well, I think what we see is banks are leaning in to businesses. They're working with their customers and leaning into businesses that look like they have good prospects.
Hey,
You know,
everybody.
you get to a place though with some of the companies that are really under a lot of pressure where they may be having a hard time getting funding.
Right. And I think that speaks to the fact that as policymakers, we have been very reluctant to do targeted relief to specific industries. But given the uncertain recovery, and I'm not going to ask you to comment on this because I think it is a question for policymakers, I do believe that we should focus a little more on some targeted
Assalamualaikum
relief to some of
warahmatullah.
those industries.
Adakah Anda ingin
That's why
mengetahui
I'm
bagaimana
a sponsor
selok-belok
of
melakukan
the
perdagangan saham
Restaurant
Wall
Act
Street
and this
seperti
new
Facebook,
Gym Act and some
Apple,
other things
Netflix,
in the
Google,
hospitality, travel,
Microsoft
and
yang telah naik
entertainment
ribuan
industries. And I
peratus?
think
Sekiranya iya,
that would be
sila
smart of policymakers moving forward. I do want to allow you, because I don't think I've heard you say it, to comment on the Federal Reserve's independence. Just remind us whether you work for any president or you're independent.
We have certain legal independence, and we think that arrangement has served the public well, and that's really the point of it, is that we're able to make decisions without considering politics, and our lives don't change when elections happen until, of course, the president has the power of appointment.
To appoint every term. Yeah. Thank you. That's. I do want to quickly move to digital currency. You had a great interaction with Ranking Member McHenry about some of your concerns on the policy questions. I just want to quickly, and you brought it up, I just want to quickly speak to the potential disintermediation that could occur with the digital dollar. While I think it's important to keeping the dollar the reserve currency of the world, I think we need to take a special look at disintermediation. And I want to just remind you something I showed you a few hearings ago of one of the last banknotes from the Citizens National Bank of Ripley in 1929 that my grandfather got to sign. I think our financial institutions might be able to play a role in a digital dollar, and I just want you to think through those things. I don't want to ask you to comment on without thinking about it, but I hope you are committed to working with our financial institutions.
Yes, that'll be part of the conversation for sure.
And the final thing, I want to talk about something Mr. Cleaver talked about, and I want to take a step back and not just focus on CRA, but focus on the gap in home ownership, the racial gap in home ownership. And I'm curious if the Federal Reserve is paying attention to that as an issue, as opposed to, you know, the four corners of a CRA document, but the issues related to reducing the racial gap in home ownership. And I know Mr. Cleaver and I on the Housing and Insurance Subcommittee are very focused on that and trying to work on some things to build a sustainable model. You know, the last time we did this under Barney Frank, we created subprime lending that ultimately blew up the financial markets. I want to make sure that when we do it, we create a sustainable model that can bridge that gap and bring up the minority home ownership rates significantly. Is that something the Fed's willing to work with us on?
We'd be happy to look at that. I mean, our principal role there is to assure, to the extent using our tools, that gap is not a function of discrimination, and it will be to some extent, but we use our tools to go after lending discrimination and try to minimize that.
Thanks for your great leadership. I yield back my time.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, is also the chair of the Subcommittee on Diversity and Inclusion and is now recognized for 5 minutes.
Thank you, Madam Chair. And thank you to Chairman Powell on being here today and providing us with your testimony on the salute of monetary policy. I want to start by revisiting a topic that I have raised with you several times over your tenure, and that is, of course, diversity at the federal level. Certainly, this is a topic that I think you can respond to, and it won't have an effect on the economy as maybe some of the other questions. You're probably familiar with that last month, the New York Times released an article entitled, "Why Are There So Few Black Economists at the Fed?" which found that of the 417 economists that are employed by the Board of Governors, only 2 Black, that's 2 out of 417, or 0.5%. While I understand that many will say that something is difficult to find or difficult to hire, just keep in mind 2 out of 417. I also understand that we need to do more to increase the numbers of Black PhD economists in general, because they only make up 3 to 4% of the population, and the Federal Reserve's representation are still lower than this number. Further, the reserve banks around the country only have about 1.3% economists that are Black. So my question to you, Chairman Powell, and let me just say for the record, I appreciate your contacting me, meeting with me, and always making great strides with OMWI and other things that you've done in this area. But are there any concrete steps that the Federal Reserve can take or that you are taking to increase the number of Black economists within its ranks? And do you believe that the Federal Reserve's role as the nation's central bank has a role to play in encouraging diversity and inclusion? And the word equity is very important to me in the economic field in general.
So I think we do have a role. We are a very large hirer. I think by some measures, the largest hirer of economists in the United States, including the 12 reserve banks and the Board of Governors. So it's, we're an important factor. And as you know, diversity is a high priority for me and for my colleagues and for our staff. And we do, what we've been doing is recruiting very aggressively and going to not just the old traditional schools, but also historically Black colleges and Hispanic ones as well, and recruiting hard when we find appropriate candidates. We also have at different levels. We've got an internship program. We do the same thing there. Sort of more from an upstream perspective. We also want to increase the supply, because there's a fairly limited supply. We don't seem to be getting our share, and we don't know exactly why that is, but we're looking into it. So we're doing everything we can. Nobody here is comfortable with these numbers, nobody. And we're wide open to suggestions on how to do better.
Thank you. I have one last question if I have time. Over the course of next year, tens and perhaps hundreds of millions of Americans will be receiving the vaccinations and will finally be hopefully placing this pandemic behind us. Looking out to an economic environment post-pandemic in 2022, let's say, what do you believe will be the potential lagging economic impacts of this pandemic? Who and what should the Congress be focusing on to address this from an economic standpoint?
Interesting. So what people is that the parts of the economy that are not open right now or not fully open will open up and people will go back to work. But what we're going to find, based on some of the surveys we've heard about, is that not all those jobs are going to come back because people have started to implement automation and things like that. These are service sector jobs, and that's been an ongoing process. It will have been accelerated. So many of those people may find it hard to get back to work, and I think they're going to need further support. So I would be looking at that over time as the livelihood that they had in the service sector may not be easy to replace. There just may not be enough jobs. There's going to be a need for training and replacement and support in the meantime, so that these people can hang on to the lives that they had and find new work.
Thank you, and I yield back.
Thank you very much. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Chairman Powell, thank you for your dependable leadership, especially during the pandemic. And once again, we appreciate your accessibility to members of Congress, especially during this tumultuous time in our economy. As Congressman Lukemeyer pointed out, in December, I led a letter to you with 46 of my House Republican colleagues outlining some of the methodological challenges with injecting climate change scenarios into supervisory stress tests. We urged you to take a measured, thoughtful, data-driven approach as you study climate impacts, while some on the other side have urged the Fed to stray outside its mandate and take a more active role in fighting climate change. In your response, you stated, and this is it, your response, you stated that, quote, Congress has entrusted the job of directly addressing climate risks to a number of federal agencies, not including the Federal Reserve, end quote, and that you'll consider climate impacts only when doing so falls within your congressionally directed mandates. In January, the Fed announced the creation of the Supervision Climate Committee, led by Kevin Styro. In a press release about the Styro announcement, New York Fed President Williams said, quote, climate change has become one of the major challenges we face, which impacts all aspects of the Fed's mission. President Williams' statement seems contrary to the stated board position from your letter and your response to me. Can you please clarify his statement and how the new SCC fits within the board's limited mandate?
So I'm not familiar with the context or that statement. I'll just say, though, that we do see the job of the Supervision Climate Committee, and our job, frankly, is to assure that the institutions that we regulate and supervise are resilient to all the risks they face, and that includes climate risk. That's a conversation we're having. And by the way, all of the large and medium-sized financial institutions are already having that conversation too.
Well, let's drill down a little bit about how expansive the Fed will get into this, because as you know, the Fed recently joined as a member of the Network for the Greening of the Financial System. The NGFS has made some recommendations that, if implemented in the United States, could have harmful effects on U.S. banks and the businesses they serve. Our letter asks that you not import any NGFS standards that would harm the financial system or U.S. businesses, and in your response, you committed to this. How do you plan to evaluate NGFS proposals through the lens of upholding this commitment?
Well, as I said in the letter, as my colleague and I said in the letter, we're not going to import anything into the United States that we don't think is appropriate for the betterment and support and safety and soundness of the U.S. financial system. But we're actually at a much earlier stage than any of that conversation would suggest. We're really engaged in outreach and in thinking about frameworks. We're talking to these institutions. We're talking to supervisory institutions here in the United States and around the world. So we're at an earlier stage than.
Well,
I suggest.
And that's good to hear, but I do worry that injecting climate risk scenarios into stress tests could perpetuate the trend of debanking legally operating businesses like fossil fuels. In your letter, you commit that the Fed will not dictate what lawful industries regulated firms can serve. Even without a directive from the Fed, climate scenarios and stress tests may compel firms to debank certain industries to satisfy the spirit of the tests. My comment here is that limiting capital allocation to specific industries may itself have implications on financial stability and economic growth through lost jobs, higher energy prices, and compromised energy security. And final point here,
I would like the Fed to keep in mind that choking off capital to fossil energy will not only produce the kind of reliability challenges we saw last week in Texas, it will undermine the Fed's maximum employment mandate. Final question on inflation. Yesterday, you said you weren't concerned about the threat of inflation, but some of the economic indicators are blinking warning lights for me. High asset prices, rapidly rising bond yields, elevated commodity prices, historically high year-over-year increase in the money supply as measured by M2. And these are on top of the unprecedented monetary and fiscal stimulus enacted last year and the $2 trillion fiscal blowout this week. Within the bounds of the Fed's new monetary policy framework for a long-term running average target for inflation, how high are you willing to let inflation get, and for how long before you step in?
We don't have a formula in mind. I would just say that, as I've said, earlier, we do expect inflation to move up, both because of some sort of technical calculation reasons called base effects, but also because we'll have a surge in spending perhaps later this year. We don't expect that that will be particularly large, or even more, that it will be persistent, because it's in the nature of a one-time thing, whereas inflation is a process that gets going over a period of years, and we don't think, and we're committed to the idea that it will not become a persistent thing. It is ultimately the credibility of the Fed and our commitment to our price stability mandate that holds inflation where it is. We haven't changed that.
Well, thank you for monitoring that closely, and I believe my time has expired, and I yield back.
Thank you. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes. Mr. Lawson is recognized for 5 minutes. Mr. Lawson.
Am I unmuted?
Yes, I can hear you.
Okay, thank you very much. Thank you, Madam Chair, for calling this meeting. The Federal Reserve warned of significant rise of businesses, bankruptcies, and steep drops in commercial real estate prices in a report published on Friday. Commercial real estate, which I have a great deal of interest in, might be hit again after the pandemic. Some economists say an increase in people working from home could result in less demand for office space, while stepped-up online purchases could force more shutdown of brick-and-mortar retail and additional vacancies at shopping centers. My question to you, sir, is what is the Federal Reserve plan for commercial real estate?
Well, we don't have a plan specifically for commercial real estate. I will say that we do see a number of sectors of commercial real estate that are under pressure, as you suggest, particularly office, hotels, things like that, which are directly affected by pandemic. The best thing that can happen for the commercial real estate sector is for the economy to get back to full operating status, by which I mean get the pandemic behind us.
Okay, and there's been a lot of interest even last year in this particular situation, especially as it relates to hotels, the number of people that have been laid off in that industry, which is significantly higher in that particular area than maybe it is in bailing out the airline industry. Do you see any similarity in the retail industry as related to the airline industry that we bail out?
Do I see a similarity between the retail industry and those decisions are not decisions for us. That was a decision made by Congress and the administration as to the provision of the particular funding for airlines. We're not part of that discussion.
Okay.
We weren't part of that
Well,
discussion.
okay, thank you. It has been suggested by some that all of our challenges with unemployment, homelessness, and poverty will be solved if we simply lift local restrictions and open up our economy. But since the beginning of this crisis, you have stressed that that the path of the economy continue to depend significantly on the course of the virus. Will you please elaborate on why this is the case, and will the economy fully recover if people don't feel safe and comfortable that the virus is contained?
Yes, I will. A big part of the parts of the economy that are not operating at full capacity are the ones that are affected directly by COVID. The rest, big parts of the economy are largely recovered or even fully recovered, but that part of the economy is not. And that's travel and leisure, hotels, entertainment, all those things. And you know, what those sectors really need is an end to the pandemic, and people will then become confident again that it's okay to stay in hotels, okay to go on vacations, okay to go to bars and restaurants. And I frankly think that'll take some time. And I think that is the single key factor in getting that done. That process started and then completed will be bringing the pandemic to a decisive end as soon as possible.
You know, back in January, my time to run out, you stated that the winter months were going to be extremely hard on the recovery of the economy. Have you seen that your statement has been pretty much right in terms of where we stand at this point in the recovery in the economy?
Yes, so we did go through a very large spike in cases. As you know, they're coming down sharply now. The economy did kind of go sideways for the last, through January. I mentioned in my testimony, 29,000 jobs a month. It was much higher last summer. And, you know, I think as the pandemic recedes, if it continues to recede, new cases are way down, hospitalizations are way down, then we'll begin to see, maybe fairly soon, we'll begin to see the job numbers start to creep back up. And hopefully this time that'll be consistent with keeping the virus under control, getting it really under control.
Okay, thank you. With that, I yield back.
Thank you very much. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. And also, Mr. Chairman, thank you for being before our committee today, this virtual setting. You know, you mentioned that there could be 6% growth. We've talked about that all day today by the end of the year, and I completely agree.
No,
And
they
think
got to be much faster than that.
the fundamentals are there for the economy to easily rebound at this pace. The biggest obstacle I see that would prevent the level of growth from becoming a reality is individual states focusing businesses, forcing them to remain closed. Now, for states like mine, Texas, the great state of Texas, that have responsibly opened their economies, people are getting back to work. And in December, Texas added 64,000 jobs, while states that are still under heavy lockdowns like California had over 2,000 jobs lost over that same period. So as we talk about the next step in COVID relief, it needs to be focused on getting people back to work. So, Mr. Chairman, what would be the best allocation of resources that would incentivize reopening the economy?
Well, I would say again, I'm, as you know, I'm reluctant to comment. I'm frankly not. I shouldn't comment on the legislation that's under consideration, and I won't do that. But I'll say again that I think it's at this point the single biggest thing is to get people vaccinated and get the pandemic under control in a decisive kind of a way, and then the economy can fully reopen and people can get confident again that it's okay to resume their normal activities.
Okay, I'll buy that. My district contains some very rural areas that do not have access to reliable broadband internet. And the COVID-19 pandemic has exposed how necessary it is to be connected to the internet if you want to run a business, take advantage of telehealth capabilities, or educate your children. We've got some strange stories that people have to find hotspots in my district and drive hours to get there. Chairman, can you tell us what it would mean for the economy, economic recovery, if we were able to get investment in broadband infrastructure for the thousands of American people that are currently being left behind in this digital world?
Again, without commenting on the bill, I would say that broadband is just an essential piece of 21st century infrastructure, and having good broadband everywhere in the country will will help people in rural areas and poorer people who may not have access and things like that. It's a very important piece of infrastructure for us to have as a nation.
Well, it is, and surprisingly, like I said, in my district, a lot of rural America still does not have it. We need to get that, and I think we agree on that. Lastly, during the Trump administration, you were applauded for maintaining the independence of the Federal Reserve and focusing on your dual mandate of price stability and full employment. You're going to be pushed once again during the Biden administration to use the power of the Federal Reserve to pursue additional political goals, such as addressing income inequality or climate changes. And I just want to reiterate that some of my colleagues have already brought that up, and Congress is the body that must debate and act on these ancillary issues, not the Federal Reserve. So in closing, Mr. Chairman, can you tell us listening today why it's important for the Federal Reserve to stay independent and not act on the political needs of the moment?
I will. I'll be happy to. The independence of the Fed from direct political control is an institutional arrangement that we think has served the country well, and that's why we have it. It's not something that's in the Constitution. It's a practice that we have. We don't engage in political discussions over here. We don't take politics into consideration or election cycles or anything like that. Nonetheless, we try to be extremely transparent and really work hard to stay in contact with the body that has oversight responsibility in our system of government, which is the two committees on Capitol Hill. That's where our oversight responsibility is, and we take that very seriously.
Well, I will turn my time back. I want to thank you for the job you're doing and appreciate your the hard work that you've generated these last several years. So thank you very much. And Madam Chairman, I yield my time back.
Thank you. The gentlewoman from Iowa, Ms. Axley, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chairman Powell, for being here. It's good to see you. I want to focus on the labor market a little bit here. You said a couple of weeks ago that published unemployment rates have dramatically understated the deterioration in the labor market. And as I understand it, that difference is mostly about the decline in labor force participation. Is that correct?
Yes, that is correct.
So that's something that I clearly see in Iowa. Our unemployment in December actually fell back below 3.5%, but that ignores about 130,000 Iowans who've just left the labor force completely. Is that something that you will be looking at closely when it comes to determining if the economy is at full employment, those folks who have literally just left the market?
Yes, it is. We say that we look at a broad range of things, and it's important to say that we look at the employment rate and employment to population, in particular, as a statistic that combines labor force participation and unemployment.
Okay, good. I'm happy to hear that. So changing course here a little bit, we've seen about 4 million people leave the labor force. Almost 60% of those have been women, despite them making up, of course, less of the labor force before the pandemic hit. And then we hit a 33-year low last month, and more than 1 million more women have lost their jobs than men. I would ask you, Chairman Powell, what do you think is the reason for this kind of disparity? And is that something you're going to consider when you're evaluating full employment?
It's a combination of two things, I believe. One of which is that women are within the labor force overrepresented in those public-facing service sector jobs. The other just is with the closure of many schools, parents are staying home, and that burden has fallen more on mothers than it has on fathers. Those are the two pieces of that, I think. And both of those should dissipate, and we'd go back to hopefully something closer to where we were, where people worked if they wanted to work, and they did childcare if they wanted to do that instead. So as the pandemic comes to an end, we hope that people once again be able to make those choices without taking into account the fact that the schools are closed, for example. So.
Thank you. Listen, I'm so glad to hear you bring up childcare because apparently more than $50 billion a year is what the lack of childcare costs our country. Do you think that helping families find affordable childcare could help the economy? And do you think that would help us get back to full employment more quickly?
I do think that's an area that's worth looking at. And again, I don't want to comment on I don't know what's in your discussions, but I don't want to comment on that. I will say many other countries, our peers, our competitors, advanced economy democracies have a more built-up function for and for childcare, and they wind up having substantially higher labor force participation among women. We used to lead the world in female labor force participation a quarter century ago, and we no longer do. And it may just be that those policies have put us behind.
I appreciate you saying that. Countries like Germany, UK, and Canada have moved forward with higher levels of that participation because of those programs. And it's absolutely something we need to address in this country. Obviously, even before the pandemic, it was prohibitively expensive for families. I've been there. I have 2 boys, and at the most expensive time, even 15 years ago, it was you had to save $20,000 after taxes, and that was 15 years ago for a couple kids. So I know that this is really hurting Americans, and there are childcare deserts. The lack of childcare and paid leave as well really limits the choices for women in America. And every time one of them leaves the workforce to take care of a child, it sets their career back multiple years. So I just want to be clear, this isn't just a women's issue, it's a family issue, it's an economic issue. And I worry that the current crisis for childcare could get even worse. It's why it's so important to address these types of long-term issues if we're going to be back to where we need to be as a country. I would also encourage you to look at how paid family leave, paid sick leave, all of those issues impact opportunity for women and for families, which in turn, of course, impacts our overall economy. I want to thank you for the work that you're doing. Appreciate everything that you're doing to try, make sure that we're informed and keeping our country moving forward. And I'd encourage you to take a look at those issues. And lastly, I'd say on the paid family leave, is that something else that you would be considering looking at when it comes to labor market?
Those are decisions that lie in your hands, but I do think it's worth looking at these. As the United States falls behind in labor force participation, we need to be asking why that is the case and what are the ways we can be more competitive on it.